Most people holding XRP have no idea how quickly the door of opportunity can close right to their faces. And it closes the moment retail investors get permanently priced out of the markets. There is one fatal mistake that will affect 95% of XRP holders, and I don't want you to be one of them when I explain the numbers and the details. Here is the truth almost nobody wants to hear. Almost nobody is properly positioned for the real XRP move. Everyone believes they will simply buy more XRP later. They will wait for the dips and the corrections, trade their positions thinking they're smart, and tell themselves there will always be another chance. If you're serious about getting ahead of this next major financial shift, XRP Insiders Elite is where you need to be. You'll get exclusive insider XRP alerts, the millionaire mindset frameworks that build generational wealth, and the exact strategies the top 1% are quietly using, plus full access to every premium resource. It's all in the video description below, and you can use code MILLIONAIRE for 10% off. Because here's what almost nobody understands. This fantasy that you'll simply buy the dip later does not match how institutional markets actually move. People think that timing XRP will be as clean and predictable as trading any other altcoin. They believe they'll be able to exit at the top, calmly wait for a crash, and slide right back in at a lower price like nothing happened. And they're so confident in that plan that they don't even question the reality behind it. I run a private trading group. I'm in crypto 24 hours a day, 7 days a week. And even with all my knowledge and all my tools, I didn't sell XRP above $3 to buy it back later. Why? Because the biggest danger in the XRP market isn't price volatility. It's liquidity evaporating right in front of you while you're still waiting for the perfect entry. This is the single mistake that is going to price out 95% of XRP holders. That buy-the-dip mindset is not just flawed, it's destructive. For most assets, dips are predictable, orderly, and based on typical market cycles. But XRP is not acting like a retail asset anymore. It's transitioning into an institutional-grade liquidity instrument, and that changes everything. When a market shifts from retail-driven to institution-driven, price stops being the metric that matters. Liquidity becomes the real battleground. And liquidity is exactly what retail never pays attention to. The buy-the-dip mindset assumes something extremely dangerous, that centralized exchanges will always stay liquid and available for your re-entry. That assumption is false, because once institutions begin absorbing XRP supply at scale, they can drain the order books faster than any retail trader can hit the buy button. And the most important part, they're not going to announce that they're doing it. They're not going to tweet it. They're not going to tell the media. They're not going to warn you that the last window for affordable entry is closing. If you look at how BTC was accumulated from 2011 to 2020, the pattern is identical. When Bitcoin was under $1,000 and even under $10,000, large financial institutions and funds were quietly buying massive quantities of BTC. But what were they telling the public? They were calling Bitcoin a scam. They were calling it a bubble. They were telling you to stay away. They were discouraging the exact behavior they were privately engaging in. And by the time retail realized what was happening, they were already priced out forever. You can't buy Bitcoin under $200 today. You can't buy it under $1,000 today. You can't buy it under $10,000 today. The people who waited for one more dip missed the entire move. Not because they were wrong about price trends, but because the liquidity window closed faster than their decision-making process. Now, apply that exact dynamic to XRP, except this time with far larger entities involved. XRP doesn't trade like a typical crypto anymore. It trades like a future global settlement rail. The real buyers aren't random retail traders scalping 5% candles. They are banks, funds, corporates, treasuries, ETF desks, liquidity providers, custodians, and global money movers who absolutely do not care about your emotions or about catching a perfect entry. They don't operate with the wait for a pullback mentality. They operate with a secure as much supply as possible before everyone else wakes up mentality. That is why this moment is so critical. When a market transitions into its institutional phase, everything speeds up, the supply dries up, order books thin out, market depth collapses, and price becomes a reflection of scarcity rather than speculation. That is when retail gets permanently priced out. It's not when XRP hits $10 or $20 or even $100. Retail gets priced out when exchanges simply don't have any meaningful XRP left to sell to you. When the available circulating supply becomes a fraction of what it used to be. When liquidity is no longer driven by weekend traders, but by trillion-dollar settlement flows. And here's the part that stings the most. Retail will be looking at the charts the entire time, thinking everything is normal. They'll be watching RSI, they'll be watching moving averages, they'll be watching support zones, but the chart won't warn them about a supply shock. Technical analysis does not predict liquidity evaporation. Exchanges don't send push notifications telling you that the last affordable XRP has been purchased. Coinbase won't tell you that market makers are gone. You simply wake up one day and realize you missed the one window that mattered. People assume they'll see warning signs. They assume there will be a big announcement. They assume institutions will buy slowly and visibly. But that is not how accumulation works. It happens silently. It happens while everyone else is distracted. It happens while retail is arguing about price predictions on social media. And by the time you notice what's happening, it's already over. This is where the real danger begins, because most people don't even understand the role exchanges play in that equation. When you buy XRP on an exchange, you're not interacting with the same liquidity institutions use. You're interacting with the smallest pool available. And if a supply shock hits, that pool is the first to evaporate. That's why retail gets stuck. And that's why the majority never get back in once the market transitions. And the biggest risk of all, most XRP holders don't even practice self-custody. They hold on exchanges. If there's a liquidity event, a regulatory freeze, a solvency issue, or an institutional drain, those coins can disappear overnight. FTX proved that. One single morning, billions in user assets vanished from the world. People who thought they were safe learned the truth the hard way, and most of them never got their assets back. The next question everyone eventually asks is, what actually triggers the XRP supply shock? Because if you misunderstand this part, you underestimate how quickly everything can shift. Most retail investors picture a dramatic moment, some massive news event, some big announcement, a global press conference, ripple on stage with world leaders telling the entire financial system to switch to XRP overnight. They imagine flashing headlines, price charts exploding, and everyone suddenly knowing exactly what is going on. But that is not how real systemic shifts happen. Financial infrastructure transitions are quiet, boring, and invisible until they're fully complete. By the time the public sees the front-end effect, the back-end infrastructure has already been running for months or even years. And that's the key. The XRP supply shock doesn't begin when the news goes public. It begins the moment institutions start testing, piloting, and routing real transactional volume through XRP rails without retail knowing anything about it. This quiet ramp-up phase is where the real accumulation happens. Because think about it, banks cannot wait until the last minute to source liquidity. Liquidity must be secured before the system is scaled. That means the real buyers, the ones planning to route high-volume settlement flows, have to accumulate well in advance. They have to run stress tests. They have to model throughput. They have to ensure they can move money reliably across corridors. And they need access to large amounts of XRP to do that. This is why institutions absorb supply silently. They must be prepared before the market understands what's happening. Now combine that with something most people overlook. XRP's liquid supply is not as large as people think. Yes, billions exist, but only a small fraction is truly liquid on exchanges. The rest is locked, controlled, held by long-term entities, or simply not for sale. When a buyer with institutional firepower steps in, they aren't competing with millions of casual traders. They're competing for a tiny slice of available supply. That's how a supply shock forms. It doesn't require trillions of dollars. It doesn't require every bank in the world. It only requires a handful of major players stepping in at the same time, especially if they're all testing new corridors or preparing for future settlement operations. This is also why the traditional idea of waiting for a dip becomes irrelevant. In a retail-driven market, dips form because retail panic sells interfere and price collapses temporarily. But when institutions buy, they don't sell back into fear. They don't liquidate on volatility. They don't dump into market corrections. They hold because they're building infrastructure. That means the usual cycles break down. Dips become smaller. Corrections become shallow. Liquidity dries up, and the market floor steps higher. You won't get a perfect dip when the buyers are not emotional traders, but structured financial entities with multi-year strategic plans. Now, let's talk about something even more critical: transactional liquidity demand. This is what most people underestimate the most. XRP isn't just an asset, it's a liquidity tool. And as adoption scales, the demand for liquidity isn't based on speculation. It's based on functional throughput. If an organization wants to route $500 million per day through an XRP corridor, they must hold enough XRP to settle those flows. Multiply that across multiple corridors, multiple partners, multiple institutions and emerging use cases, and suddenly the demand becomes exponential. This is where retail gets blindsided, because retail thinks strictly in terms of investment. They ask, will XRP hit $10? Will it hit $100? But institutions don't care about investment upside. They care about liquidity performance. They need enough XRP to handle volume. They need reliability. They need depth. And they buy accordingly. This difference in mindset is exactly why retail gets locked out. Institutions accumulate based on necessity, not price speculation. And when buyers operate from necessity, they outbid retail every single time. They don't wait. They don't hesitate. They don't look at fear or greed indexes. They simply acquire what they need. Now add another layer on top of this: regulatory clarity. Most retail investors imagine regulatory clarity as a single moment, a switch flipping from uncertainty to certainty. But regulatory clarity unfolds in stages. Precedents get set, legal language tightens, frameworks become clearer, and institutions begin taking positions quietly, long before the public understands what those changes mean. Each step of regulatory clarity unlocks new categories of institutional buyers: wealth managers, family offices, hedge funds, custodians, ETF issuers, banks, and corporate treasuries. Again, these buyers don't warn retail. They don't announce their intentions. They accumulate in silence. One of the most misunderstood aspects of this entire transition is the concept of on-chain visibility. Retail assumes that if institutions buy large amounts of XRP, the blockchain will make it obvious. But institutions don't buy on retail exchanges. They source liquidity over the counter. They purchase through private arrangements. They acquire from custodians, brokers, and liquidity partners. They transact in ways that leave no clear trace on charts or price action until the shock has already happened. This is why retail never sees it coming. And here's another layer almost nobody talks about: liquidity routing. When new corridors launch, when new institutions begin using XRP for settlement, liquidity must shift to meet demand. Market makers adjust. Order books rebalance. Regional liquidity hubs absorb more supply. Sometimes this creates temporary price dislocations. Sometimes it creates sudden gaps. Sometimes it creates silent liquidity drains where XRP disappears from exchange availability without any major price spike. This is the early stage of a supply shock. The part that looks invisible, the part that retail ignores, the part that doesn't show up on charts. Another factor almost nobody anticipates is the impact of custodial migration. When institutions onboard XRP, they rarely hold it on exchanges. They move it to custodial vaults, cold storage, or managed institutional wallets. Once that XRP enters these environments, it effectively leaves the liquid market. It's not circulating, it's not being traded, it's not contributing to market depth. It's locked. When enough XRP moves into long-term custody, the liquid supply collapses, and price can skyrocket with minimal buying pressure because the market becomes thin. This is why the supply shock is so powerful. It's not about one institution buying. It's about the aggregate effect of many institutions securing long-term positions simultaneously. Let's also address the psychology behind retail reactions. Retail investors tend to respond emotionally. They chase green candles. They panic when price moves sideways. They expect predictable patterns. But institutions don't think this way. They plan years ahead. They accumulate over time. They don't react to headlines. They react to strategy. When retail hesitates, institutions accumulate. When retail hopes for dips, institutions buy out the order books. When retail waits for confirmation, institutions act on private data, strategic partnerships, pilot program timelines, settlement testing phases, and internal projections of future demand. By the time retail sees confirmation, the door is already closed. And the final piece, the trigger. The supply shock isn't caused by hype. It isn't caused by speculation. It isn't caused by influencers or predictions. It is triggered by utility demand surpassing liquid supply. The moment functional usage grows faster than exchange availability, the price begins to detach from traditional trading patterns. It becomes driven by scarcity and necessity. This is not financial advice. Once the XRP supply shock fully takes hold, the entire landscape of accessibility changes. Most people never think this far ahead, because they assume the future will look like today. Exchanges available 24/7, order books full, liquidity abundant, and XRP always sitting there waiting for them whenever they feel ready. But that's not how transformative assets behave when they graduate from a retail market into a global infrastructure layer. The moment liquidity evaporates from exchanges, several major consequences hit retail investors all at once. The first is the most obvious. You can't buy XRP easily anymore. You'll see the chart, you'll see the price, you'll see the headlines, but you can't get exposure to it at the moment it matters most. This is the same thing that happened with Bitcoin in the early days. When institutions began accumulating massive amounts of BTC, retail investors weren't just priced out, they were cut out. Supply dried up. Open trade desks were drained. Exchanges ran thin. And the only people who could acquire meaningful amounts were those already positioned. XRP will follow a similar pattern, but likely at a much faster pace, because XRP's utility is tied to real-time settlement. Unlike Bitcoin, which is mainly seen as a store of value, XRP has functional throughput demand, and that changes everything. The buyers aren't speculators. They're entities that need liquidity to operate. When those types of buyers step in, they don't just buy a little. They buy what's required for operations, for future scaling, for corridor expansion, and for reserve buffers. That alone is enough to make XRP scarce. But scarcity is only the first layer. The second consequence is the breakdown of retail price anchoring. Retail investors imagine XRP rising in a step-by-step manner. $5, then $10, then $20, then $30, slowly climbing with healthy pullbacks in between. But a supply shock does not behave like a normal pump. It behaves like a repricing event. It's not about the market moving up. It's about the market realizing it mispriced the asset by a massive margin for years and recalculating instantly. This is how assets leap from one price range to another without slowing down. They don't grind their way through resistance levels because the liquidity that normally creates those resistance levels is gone. Thin order books mean a relatively small amount of capital can move price dramatically. And once institutions recognize that more supply isn't coming back to exchanges, they adjust their models. This is when the price skyrockets so quickly that retail can't make sense of it. The third consequence is psychological, and this is what catches most people off guard. When XRP becomes less accessible, retail investors begin to panic. Not because price is high, but because they suddenly realize they can't obtain the asset at any price they feel comfortable with. This sparks a wave of fear-driven demand. Not FOMO in the typical sense, but fear of permanent exclusion. People begin scrambling, refreshing charts, checking every exchange, hoping for one more sell-off, one more correction, one more opportunity that will likely never come. And ironically, this panic demand accelerates the supply shock even more. This is the same pattern that played out in every asset class that transitioned from early stage to institutional grade. Whether it's Bitcoin, rare commodities, land, metals, or even equities before they gained widespread access. Once the door closed, it didn't reopen. Retail never got the entries they were waiting for. They were priced out not because of a lack of desire, but because of a mismatch between their expectations and reality. The fourth consequence is the rise of secondary price premiums. When exchanges have thin liquidity or temporarily halt trading due to overload, alternative markets begin placing premiums on the asset. This means the price listed on major exchanges may no longer match the price people actually pay on other platforms. In the early Bitcoin days, premiums in different regions or on different exchanges reached 20%, 40%, even 80% during supply squeezes. If XRP experiences a similar phase, which is extremely likely, retail investors may be forced to buy at much higher prices than the official chart suggests, simply because availability becomes the primary factor. And once liquidity becomes a privilege rather than a default, price becomes secondary to access. Another hidden consequence is the collapse of retail-friendly trading tools. When the market is liquid, you can set limit orders, ladder your buys, DCA, hedge your positions, and manage risk. But when XRP's liquidity dries up, all of that becomes far more difficult. Your orders may not fill. Price may jump over your entire range. Slippage becomes brutal. Traders who are used to having endless options suddenly face an environment where options barely exist. This is why the supply shock doesn't just price retail out financially. It prices them out structurally. Now we get to one of the most misunderstood aspects of all the role of liquidity providers. Liquidity providers, market makers, and institutional desks act as bridges between buyers and sellers. They ensure spreads remain reasonable. They manage depth. They stabilize volatility. But during a supply shock, liquidity providers face a different set of incentives. If XRP is rising because liquidity is evaporating, market makers have no reason to keep deep inventory on exchanges. They pull liquidity. They tighten access. They widen spreads, and exchanges begin limiting large orders. This creates a cascading effect where the average retail investor sees XRP but cannot meaningfully interact with it. Not because the system is broken, but because the system has evolved past the phase where retail access is prioritized. This is the moment where the realization finally hits. You don't get back into a market once it has moved into institutional territory. You get one chance to accumulate an asset before infrastructure demands absorb it. After that, the market becomes a different environment with different rules. And this is where the final consequence lands the hardest: the permanent shift in narrative. Once institutions are the primary holders of XRP, the story changes forever. Media coverage changes, analyst estimates change, liquidity models change. The asset moves from being a speculative play to being recognized as a core financial tool. And when that narrative solidifies, retail investors no longer dictate price. They become spectators, not participants. This is why the opportunity exists now, before the supply shock. Before XRP becomes infrastructure grade, before the liquidity window closes. Because once that window closes, history shows it never opens again. If you want to stay ahead of this next financial shift, you need to get XRP Insiders Elite. You'll get access to exclusive XRP Insider Alerts, the millionaire mindset frameworks used by wealthy investors to build generational wealth, and the strategies the top 1% crypto elite are quietly using. Plus, get full access to every premium resource. It's all linked in the video description, and you can use code MILLIONAIRE at checkout for 10%.